Good morning, everyone, and thank you for joining us for the Prescient Balance Fund update for 2021 quarter one. Bastian, who was recently appointed as Chief Investment Officer of Prescient Investment Management, and Rupert will also be taking us through the upcoming discussion points. And what we're going to be looking at for today is where value lies in South African assets, the impact of inflation on capital markets, what a steepening yield curve means for global assets. Bastian and Rupert will cover the fund in further detail, but just to quickly highlight the process of the fund for some of our new attendees, the Prescient Balance Fund was launched 7 years ago with the design and intention of being a peer-cognizant fund, providing investors with a predictable and reliable means of investing, with a long-term objective of outperforming CPI plus 6 within the Regulation 28 framework. The fund can be found and is available on most platforms, including Momentum Funds at Work platform. And also we've adopted the same process and philosophy in our USD dollar-based balance fund. So if you have any questions throughout the session, please use the Q&A functionality in the session, and we'll answer them at the end of the session. Thank you very much. Over to you, Bastian and Rupert.
Thanks, Jason, and yeah, thanks to everybody for having us once again. Really looking forward to this interaction. Now we've got 1 hour today, so a little bit more time to spend. I'm going to start off by speaking about not necessarily performance, but we call this section performance steady and reliable. So we will touch on performance, but for us it's more about the path and the journey which our clients experienced. As my colleague used to say, performance is basically the target, but the way you travel also matters. So we want to make it safe and steady for you. So how do we get there? And before I even start to explain the details once again, I want to cover with a kind of like, I want to say like old or long-lasting discussion, which is still topical, which is active versus passive. And just to take one thing ahead, we're not going to shout off the rooftops why passive investing is so much better. So we're also not going to tell you why active investing is so much smarter. So we're taking a quite balanced stance on that, and I do think we are finding the balance not in between, but by basically carving out the nice elements of both investment approaches in one solution. So our goal is really not to have, like, to answer the question, must I have 20% actives and 80% passives, or 80% actives and 20% passives? For us, that's a question which you shouldn't be asking yourself. We do think that there are ways to get all the benefits of both approaches into one solution. So we're going to start by looking at passives. Why do we like passives? Low fees. Well, that's the most often and most commonly stated reason for the push from active to passive. Our fund has a 30 basis point management fee, so it is very, very affordable. Low transaction costs, another good reason. So we don't encounter STT because of our portable alpha process. We use our own in-house trading desk. We have a securities business within the group. We are very, very obsessed with keeping costs low, and that doesn't just apply to the fees, but also to transaction costs. We're avoiding the costs of having to pick small caps. So all of that doesn't happen with our investment approach. So we are basically avoiding the turnover cost and the brokerage there entirely. A low tracking error. So it's also important to have low tracking error. Another reason why passive funds are so popular, because you kind of know what you get. If you buy a passive equity fund and equities run, well, you know you're doing well. You don't necessarily always get that with an active equity fund if the tracking error is too large. So with us, the tracking error against the peer group is low. We are tracking our tracking error and our risk against the peer group on a daily basis. We are making sure that the peer risk is eliminated and that there's basically no period where we underperform the peers. Sounds like a big promise, but I'll get there just now, how we achieve that. And yeah, just also in terms of risk management, low tracking error for us is also part of risk management, because we do think risk management is more than trying to de-risk when you deem the time to be appropriate. Risk management means to be forward-looking and to know which risks you are taking, even if you de-risk. And de-risking might mean that we are wrong on this call and the market continues to run, and then we're facing a big and massive peer risk. So low tracking error is a nice element of a pure passive fund. We've got that in our balanced fund as well. And then let's look on the active side. So why are we active? Because we're not passive. We have those attractive elements of the passive funds, but we are highly active. And why so? Well, The reason is because we can generate within asset class alpha. With our portable alpha process, we're able to add a little bit of alpha every single year. That has worked well over the last 7 years since the fund was incepted, every single year positive contribution. Efficient allocation of capital. We do review our strategic asset allocation on an ongoing basis. It's not the standard like 6 months or 12 months when we review the strategic asset allocation. Our systems and our processes and our people allow us to basically review the strategic asset allocation on an ongoing basis. So whenever there are structural breaks, shifts, changes to factors like demographics, inequality, or maybe less economic growth going forward, we will adjust asset class returns for that and re-optimize. So an efficient allocation of corporate capital is important, and that's why we think our solution is always better than a pure passive balance fund. And lastly, capturing market dislocations. We do believe in tactical asset allocation tilts. We do think that it's a smart way to try to generate alpha. Again, in the last 7 years, 6 out of 7 years, we had a positive contribution from our TIA process. And we do think if you act on high conviction and within measurable, conservatively chosen predefined risk bands, you are actually able to add value here. So if you combine all the good elements from the passives with the good elements, the right elements from the actives, you get the Prescient balance funds. And we do think that this is actually really the way to manage money. Okay, into our investment process. I'm going to start at the top right. You've seen this process before, so just to recap, we always start with our strategic asset allocation. We do really think that this is the most definitive driver of your long-term investment success. So it's incredibly important to have a strategic asset allocation. For us, there is no way around. So we completely respect that there are other investment approaches, and we are cognizant that they might be different and still as smart as ours, but we do think you need to have a strategic asset allocation as a starting point. From there, we move into tactical asset allocation tilts. So that's where we basically make sure that once markets are cheap or expensive, the economy is doing well or not so well, valuation or financial conditions are easy or tight, or sentiment is positive or negative. Like, these factors are the driving forces for financial markets, and we do take into account how they behave. We obviously measure them purely systematically through the application of a lot of data science, but doing that, we get an unbiased way of expressing tactical asset allocation tools. And from where we move in step 3, portfolio construction, where we construct our portfolios and as we think a smart way. So we don't physically pick shares, we rather port fixed income alpha on our equity building block. So that's how we construct portfolios. Implementation and trading, I mentioned that we are obsessed with low fees, we are obsessed with low costs. So for us, it's very important to use our in-house within the group trading capabilities to keep costs low. And then risk management at the heart of our process, and it's important to define risk management in the right way. For us, risk management means managing the risk that our clients are disappointed. It's not necessarily always downside risks which concern them. It might be also risks relative to the peer group. Okay, so just into the individual building blocks, I'm starting with the strategic asset allocations. You can see our strategic asset allocation on the left-hand side. It is a strategic asset allocation which gets adjusted and updated as things change. It is also learning, and it gets smarter, and we add asset classes as they become more appropriate for the overall asset class mix. A good example would be that we added high-yield corporate bonds, South African high-yield corporate bonds more recently. We added alternatives, which is in years basically piggybacking on the ESG trend of having more uncorrelated asset classes. And if you just run all of our expected long-term return forecasts through the optimizer on an ongoing basis, then you will see that at times new asset classes become favorable for the strategic long-term allocation, and then we add them into the system. You can see that it is asset allocation which is on purpose not too far away from our peers, because again, we are very cognizant of peer risk, but it is a strategic asset allocation which is well diversified, which is comprehensive, and I think which is also a step ahead in the way how we, for example, look at the currency. So if you look at the outer ring of this pie chart, you can see that yes, we've got 30% offshore, and 70% in South Africa. Regulation forces us to be positioned like that, but then there is a dollar hedge in there. So we're also smart about basically decoupling asset classes from currencies. So can be positive on an asset class, but it doesn't mean necessarily that we're positive on the currency in which that asset class is denominated in. So basically, decomposing it, giving our optimization engines the ability to do everything as optimal and as ideal as we can. So this gives us a long-term starting point, our 30-year outlook. If we have to go on holidays for 30 years today, this is exactly how we would position the fund. Having said so, obviously we don't have to go on holiday for 30 years to run a fund efficiently, so we can do better. In the interim, why can we do better? Because things change in financial markets, and now we're looking at the shorter term factors. So this is just a snippet of our view on South African equities. Obviously, everything, again, I mentioned that before, is derived purely systematically. I could do the same approach for any asset class which we follow. So it's just highlighting that we're doing things systematically and on a daily basis. You can see that for South African equities, we are moderately positive. You can see that at the top score of 0.16, which is above the zero line. And that's driven by valuations which are slightly negative. So we do see the market is more on the expensive side, but we are positive because we do see the economy as being positive on the margin. So the economy is turning from out of its very deep recession into a steep recovery, or has turned already, but keeps on going. And then obviously very easy financial conditions and a more and more positive sentiment. And these factors are the factors which we equally weight, combine, and from which we derive systematically on a daily basis a factor score. And we would obviously then also on a daily basis adjust and rebalance the portfolios so that they are in line with this view. Okay, point 3, this is basically our efficient portfolio implementation. That's what we will see as our third source of alpha. So step 3, and another reason why we think we are ahead of a pure passive strategy. So that would be our portable alpha process. So stock picking, we don't like it because the numbers prove that it's notoriously difficult. Only 20% get it right according to our own research, but I mean academic research and empirical studies support that. And we don't want to try to be in this 20%. Rather, we move when it comes to alpha generation to the fixed income side, where we do know that the success rate is so much higher. And then we generate this fixed income alpha and port it on top of our equity beta. So you're kind of getting the best of both worlds here. You're getting the equity beta, which is giving you a higher return than fixed income beta over the long term, but you're adding fixed income alpha, which has a higher success rate than equity alpha. Okay, so all of these 3 steps, a dynamic strategic asset allocation, a dynamic tactical asset allocation, portable alpha, all of these 3 elements a pure passive would not have. Okay? Last but not least, we also have to speak about fees. So often we get the argument, you have to, we understand that costs need to come down, and we understand that we need to lower costs, but we don't want to basically sacrifice smart investment approaches or good investment returns just for the sake of having lower fees. Well, that argument is frankly completely the wrong way around. So what we're showing on this chart is that there is actually a straight correlation between fees and returns, and it's significant on every test which you would apply, and it clearly proves that your returns are a function of your fees. So you have to have low fees, otherwise you're not going to have good returns. It is as simple as that. And if you look at our balance fund, on the y-axis it ranks quite highly. Why? Because it has done well, so it has outperformed, but on the x-axis it ranks very far on the left-hand side. Why that? Well, because of our fees are being very, very low. So if I combine all of that and then I also look where we sit against the regression line, then you can see that we are significantly above the regression line. So yes, we've got low fees, but we've done very, very well, not just because of the low fees, but also because of our active elements within our process. And I just also want to cast the attention on the right-hand side to the bottom right text box where it says historically 0.53% of extra performance comes from lowering fees by 1%. So hang on, that basically means that active investing does work, right? Because it means if you lower your fees by basically 1% by moving purely from active to passive, you only get 53 bips of outperformance. So where's the other 47 bips? Well, that is the active element, and that's what we're saying. So what we're saying is not passive is better than active. We are saying that active management works. If you do it in the right way and you don't focus on stock picking, but if you focus on the true drivers of your long-term investment success, like asset allocation, it is important to do that, and it is important to get it right. But the one doesn't exclude the other. That's all we're saying. So what we're saying is, yes, be active in the right way, but you can still have lower fees, and that's exactly what we're trying to achieve. Does all of that work? Does it come through in the performance numbers? Luckily, we can say yes, it does. So we're showing basically 3 bar charts here. The first one being the Prescient Balance Fund in blue. In red, you can see the Prescient Balance Fund benchmark, and then in yellow, you can see the ASISA South African medium equity category. And why do we show all 3? So the one thing, even if we take the balance fund out of this equation, what we actually want to highlight here is if you just compare the red and the yellow line, you can see that our static benchmark, which is not active, which is not using tactical asset allocation tools, which is not following a portable alpha approach, which is not benefiting from an adjusted strategic asset allocation or optimized strategic asset allocation. If you purely keep a static composite benchmark, you are already doing better than the ASISA South African medium multi-asset high equity category. And the reason for that, once again, is fees. Okay, fees and stock picking, those are the 2 big detractors, and we don't do them. So if you don't do them, have a static benchmark, you're already better than the average. So what we are doing now is we take this composite benchmark, which is not a peer average benchmark, because a peer average benchmark, and that's evident in this chart, is just too simple to beat. So what we're trying to do is we are trying to beat that composite benchmark bit by bit in a very, very steady and consistent way. And if you get that right, then you do know that you will get ahead of your peer group by a quiet margin through time. And that's what we're showing in this chart. So it's basically just since inception in 2007, the outperformance of our balanced fund against the peer group. It's not just about the absolute number on the right-hand side of the chart. It's not just about the fact that we've created this quite big outperformance. For us, it's more important to highlight that this outperformance was created in a very, very steady and very, very consistent way. So every single year, since 2014, since we launched the fund, every single year we have added a little bit to that outperformance. Every single year we've beaten the average peer, and that's exactly what we want to do. So as I said in the beginning, it's not just about the destination, which is outperformance, it's also about the journey. You must get there also in a smooth and enjoyable way. So at that point in time, I'm going to hand over to Rupert to take us through the current market outlook and also speak a little bit about some economic themes.
Thanks, Bastian. So to tie that into where this current outlook fits, this is focusing on the tactical asset allocation. So our current views of the market, where we are tilting away from our long-term strategic asset allocations, where we're seeing macroeconomic themes and how those macroeconomic themes are reflected within our fund via the many, many millions of data points that we capture every day. So our current outlook across asset classes, starting with equities and bonds, we are largely neutral on equity markets. There is a moderate overweight within South African equities. Bastian briefly covered that a bit earlier on. Not a value case. That value case certainly does not exist anymore after the rally of back end of last year, but it is being supported by very supportive financial conditions, improving sentiment, and a better economic picture. The rest of the world, largely neutral. So in other words, we would be at the long-term strategic asset allocation. In those cases, the value case is even less attractive than it is within South Africa. So we see that as having been a theme for quite some time, a couple of years now. The value case within offshore markets has been pretty stretched, and that's been reflected within our outlook for some time. Bonds, there's a theme across a lot of asset managers with a very attractive South African bond market, and I'll cover that in a bit more detail a bit later. But basically, it's a combination of very attractive real yields, and then from an offshore investor's perspective, there's a very attractive carry trade to invest in the rand, earn that carry trade, and get pick up on what is a very, very low rate environment in the offshore space. The rest of the world, we're seeing a tilt towards the underweights, European Union in particular, strong underweight, emerging markets mixed on underweight to a neutral. Going a bit further into the more remote asset classes, credit, we have a moderate overweight within South Africa. Again, that's countered by an underweight within emerging markets in dollar debt, and then developed markets largely at a neutral. So the theme being that South Africa is actually relatively attractive within the credit space. Real assets, we see South African property now on a neutral. That's been a development in the last quarter within our fund. We had a strong overweight within South African property. There was a strong rebound within South African property, so we captured the alpha on that one, and we have since taken off that strong overweight within South African property. The same thesis does, however, exist for South African pref shares and ILBs, both of them offering to varying degrees a strong value case, and supported by the three other factors being a strong macroeconomic picture, improving market sentiment, and financial conditions which are generally supportive. Developed market property remaining at a neutral. And then in the currency space, I'll just focus in on the Rand. The Rand has been quite a controversial one. It often comes up in questions to us. We've had this strong overweight for quite some time. We've benefited from the rally all the way from the sell-off in the COVID-19 scenario all the way back up to where we are now. There are fluctuations in that dollar-rand exchange rate, but the general trend is that it's been strengthening, and that ties into the South African bond market being attractive, South African and emerging market assets to some degree being attractive, and investors searching for yields offshore. That's coupled with a positive export environment and South Africa's current account having improved. So focusing in on South African assets, so this is just narrowing it down into the South African assets alone. And you can see, in contrast to looking at our asset space from a global perspective, when you filter this down to South African assets, it's quite a positive outlook, surprisingly, for some. We're generally a pessimistic society, but for our outlook on asset classes, there are some strong overweights within South Africa. So I'm just going to dig through a couple of those in a bit more detail and see why we see this as being strong overweights. So I mentioned South African bonds. You can see foreign holdings of South African bonds. There was a large sell-off in the COVID-19 scenario, but you can see on the far right that has since picked up. So we're starting to see a bit of a more of a risk-on appetite for offshore investors buying into the South African bond market to take advantage of that carry trade, which is extremely attractive, as I mentioned, for offshore investors, where in the offshore space yields are few and far between to come by. Looking at that in the context of broader emerging markets, you can see on this yield curve slope comparison, this is the 10 to 2 year nominal yield curve spreads. South Africa being the red ranging bar towards the right. The latest point is the square, the black square towards the top. So in terms of a yield spread, the steepness of the yield curve, South Africa is currently offering the most attractive amongst its emerging market peers. And whether that is a true reflection of heightened risk is up for debate, but we don't think that that's the case, especially versus some emerging markets where you're seeing certainly an uptick in coronavirus infections. South Africa still subdued on that coronavirus, still hasn't entered the third wave. So for us, that offers a pretty attractive investment case at the moment. Just looking at that for a carry trade for a US dollar investor, so this being the real 10-year interest rate spread between South African bonds and US bonds, you can see that is near all-time highs. So that's essentially reflecting the previous slide, where we are experiencing an extremely strong risk premium. And we think that risk premium is overstating the amount of risk that exists within South Africa. We may be biased on that one because we do live here, but we think it's just not rational for investors from around the world. So that's at near all-time highs, again offering an extremely attractive carry trade, and that influences in turn the Rand, where there will be, or could very well be, positive inflows into South African assets to capture that carry trade. Looking at the Rand in a bit more detail, this is the real effective exchange rate, so a reflection of what the purchasing power parity is of the rand to a trade-weighted dollar basket. And you can see that the trend has been downward sloping since the mid-90s, implying that it's been more and more attractive for investors to pile into the South African rand. It's become cheaper and cheaper as we go along, and we acknowledge that there will be a degree of risk premium attached to an emerging market currency, but we think that the level of pricing is currently much lower than it needs to be. So there certainly is an attractive rand case at the moment. We won't put a number on it, but we think that there is upside, a further upside on the rand from where we currently stand. Then digging into some South African asset classes, South African preference shares. So you can see this is the relative yield over JIBAR for South African preference shares. In a low yielding environment for investors, even in the South African markets, the relative yield of SA pref shares, in particular, what we focus on is the bank pref shares. We see them as a lot more stable. That's an extremely wide spread. For an asset class which offers very much bond-like returns and is very high up within the capital structure. So for us, we find that a very attractive asset class. Within the banks, it is relatively liquid, so we can trade in and out of those. And as a result, we see that as a pretty attractive asset class for the multi-asset balanced fund. Inflation linkers. This is an interesting one where we're seeing a pretty high fair value yield spread for inflation linkers. That leads in turn to a pretty strong case for inflation linkers within South Africa. What is interesting on this one is that there is in effect a stronger case for nominal bonds within South Africa. For us, we are strong overweight on both of them, so we will take tilts into both of them, providing that there's funding for that. But if you were to pick one of the two, at the moment, our view would be that we would take the nominals over the ILBs. For us, it's almost like a buyer's market where there are attractive cases, especially within real assets like ILBs, where we are spoiled for choice. So ILBs certainly remain attractive on our menu of asset classes for the balanced fund. So then digging into what the impact of inflation, the next topic for us that we see as being relevant for a balanced fund at the moment, the impact of inflation on capital markets. So there has been the question of what would the return of an inflationary environment bring to capital markets? Where do you want to be positioned? What sort of asset classes offer you a good inflationary hedge? And whether the inflationary environment is in actuality going to return. So we're going to address a couple of those questions in the following slides. So the very first one, focusing offshore on the Fed, the question is there actually inflation? So the US inflationary environment does experience a degree of cyclicality. You can see in the dark gray line, which shows the most exaggerated peaks and troughs on this chart. The dark gray line does vary over time. If you focus on the far right, US CPI dropped essentially through the floor, almost through the floor of zero, into negative real inflation, or negative a deflationary environment, in other words, and has since rebounded quite significantly, almost back to that US 2% Fed target that they have stated. There was a significant change for the Fed, well, arguably not significant, but there was a change within the Fed policy where they're now targeting a 2% inflationary average instead of just saying a 2% inflationary target. What that means is that the Fed can effectively run a US economy above full steam for a period of time in order to get an average inflation of 2%. So that is a significant difference for us. That means that we almost see it as a vindication of our view that the long-term US inflationary target is 2%. So it brings more of an emphasis on that target, and we think it is actually a positive towards our long-term views. What the market has seen on that is there was a significant uptick in the light red line, which is the 30-year inflationary swap. You can see that has been stable since late 2015, around the 2% mark. It did drop when the US actual CPI dropped, but it picked up after that, when the Fed came out quite strongly with their policy saying long-term inflationary averaging, the market has since repriced to being slightly above that 2% US inflation target, and we see that again as a tick on our investment thesis for inflation. So the point being that there is inflation, there will be inflation, but we don't think that inflation will overrun expectations, especially within the United States. Bringing it back onshore to South Africa, so the Reserve Bank has an inflationary band of 3 to 6%, of which they target 4.5% as the midpoint in that band. You can see on the far right again that we have had extremely low inflation within South Africa, lower than it has been for quite some time. We have been breaching the lower limit of that band. But what is interesting in this case, in comparison to the United States, is that the 30-year inflation swap essentially priced the inverse to what the actual CPI realized. What that means is that the market is less positive, let's say, on the Reserve Bank's ability to control inflation within that band, and they put a premium on inflation, which could potentially breach that higher end of the 3 to 6% band. So a different case to the United States, and something that we keep an eye on. So if there is inflation, I thought I'd go back to the textbooks and say, theoretically, what causes inflation, and then on the next slide, what if there is inflation, how we would deal with it. So two types of inflation, at least from the textbooks: demand pull inflation, which is something that we want within the economy, and cost push inflation, which arguably we don't want within the economy. Demand pull inflation increases real GDP, so you have a positive effect on the real economy. Cost push inflation generally decreases real GDP, so you have the inverse effect. So what causes demand pull inflation? Well, it's things that we've been seeing in the environment lately. So it's things like rate cuts, increased fiscal spending, which is particularly important within the United States under President Biden's new increased fiscal spending plans, increased monetary supply within circulation in the market, and then wage hikes can cause inflation from a demand pull side. That being, if there's an increase in wages, people have more money to spend, and there's, as a result, a higher demand within the economy. On the downside, cost push inflation, again, you can have wage hikes as being a negative, in this case, a negative on real GDP. That being, if the wages have an impact on the cost of producing goods, then that will impact profit margins within the broader economy. Inflation expectations, if those pick up, it can be a decrease in real GDP, currency devaluation, and tax hikes. So what we're looking for within South African environment is a good inflation, so a demand pull inflation, where we can see a real GDP increase. So if there is inflation, then how do we cater for it within our systematic models? And I think this brings back our themes. We always talk about these themes from a much broader perspective, but these themes do relate back to our systematic models. And I just wanted to highlight a couple of those factors that we do track in real time, and how those would pick up on these, both inflation expectations, real inflation that's realized, all sorts of inflation linked indicators that we've got here. So from an equities and properties perspective, we would see changes within fundamental valuations. If there was inflation, demand pull inflation in particular, profit margins would potentially increase, yield curves would potentially steepen, monetary policy could be introduced to encourage inflation for real GDP growth. Bonds, again, similar inputs, the same as equities for the large part, but at the same time, government spending to increase real GDP, that can also influence the bond market. Currencies, we mentioned that in my previous section, where we saw the rand as being a positive investment case. Well, we can see here that the real effective exchange rate can benefit from inflation, depending on where the inflation is, onshore or offshore. Interest rate differential, again, can benefit. The yield curve would see a pickup, and then monetary policy could potentially provide a positive for the rand. How that affects the asset classes within the balanced fund. So we have asset classes which I would argue would be inflation hedges. Some are partial inflation hedges, and some are arguably non-inflation hedges. What's interesting is that the predominant allocations of those are within the inflation hedging environment, and I think that reflects the target of the Prescient Balance Fund being a CPI plus target. So we do aim to beat inflation. And as a result, the asset classes that we choose within this fund are generally, to a degree, inflation linked. The asset classes you see on the right-hand side provide us with an effective diversifier in the event that those higher growth asset classes do sell off on the left within the inflation hedging section. So I think that gives a broader picture of what inflation might bring if there is a pickup in inflation, especially for the Prescient Balanced Fund. We don't see it as a bad thing, depending on whether that inflation is demand pull, cost push. But in either case, we have got protection measures in place within the fund. We expect to pick up those different types of inflation if it does come around, and the fund will tilt away from or into asset classes which we see as being attractive in those particular scenarios. So with that, I'm going to hand back to Bastian just to take you through what a steepening yield curve, so in this case, what the yields on bonds might mean for global assets in general.
Thanks, Rupert. Yeah, so a lot of we've got a strong view on inflation generally, which influences our positioning. But just to also be clear, it doesn't influence our positioning in the way that we say, okay, inflation is coming or not coming, and that's why we position the funds in line with X, Y, that. So that's not what we do. So what we were just highlighting is basically that we have a view on inflation, but we are always tracking and making sure that our systematic models are automatically picking up these themes as they emerge. So two different views on inflation in South Africa, a view that, or like a more cautious stance, that inflation being very low, probably a reversion to a higher level of inflation is likely, which would then mean that real yields, especially in the cash and income space at the front end of the curve, are most likely going to remain very, very low. While in the United States, the story is slightly different. So there we see a lot of like positive inflation. Inflation in South Africa is also coming from the right direction. But in the United States, we see some hints that inflation is going to be driven higher by a positive view. But also we have no anticipation of seeing major spikes here at all. So here we do think that the move higher in inflation, which we're seeing right now, is actually very, very temporary, and that we will keep inflation rates at quite low levels for the foreseeable future. Okay, and one theme which we want to cover as well, because we got a lot of questions from our investors, from our clients, on the steepening of the US yield curve as of recent. So basically, what are the implications? What are the implications for equities, for bonds, for cash, for the rand? Is it a warning sign? Must we start to de-risk? So how do we at Prescient see the steepening in the US yield curve as what do we make of it? And in a nutshell, our conclusion is that all of this is very positive. So, which is maybe a little bit contrarian to some of the views which had been taken in the market. It's also contrarian to what the bond market priced for, because after we saw a steep spike in the US yield curve, so the back end of the US yield curve moving higher, we actually saw a sell-off in South African government bond, which was a little bit of a surprise for us. Having said that, we saw a stronger rand, we saw stronger equities, we saw stronger property prices. So the theory that this is actually a risk-on trade and all positive did hold. So I'm very happy for us to have to go with a slightly contrarian claim. So long story short, our conclusion on this view is that we do think the steeper yield curve indicates greater growth than expected inflation. So that's exactly the positive demand pull inflation which Rupert mentioned earlier. We have not seeing an issue if the yield curve continues even to steepen. So if the US 10-year rate moves higher and higher from where it is, we do not see the Fed reacting. We do not see the Fed being concerned. We do not see it as an issue to any extent. So what are we looking out for? So basically, so long high interest rate at the back end curve, everything is positive. Okay, all good, because it's driven by the right forces. So what are we looking out for? So where could higher interest rates potentially pose a risk to equity markets or to risk assets in general? Well, that happens if the front end of the curve moves higher. So if basically once we see that the Fed is priced for interest rate hikes, so once we see that the 2-year or the 3-year rate moves higher, and then we see the slope of the 10-year, 2-year spread flattening, that's a point in time where we start to become concerned, because that means that we will see tightening financial conditions, and that's basically the Federal Reserve taking away the punching ball. So that's where we start to be concerned. That's not what we're seeing right now. What we're seeing right now is exactly the opposite, a Fed which keeps on coming out very, very dovishly, which keeps on pronouncing that interest rates are going to stay long, which keeps on pronouncing that QE is going to stay in place throughout not just 2021, but even 2022. And a Fed which is pronouncing that they will keep financial conditions very, very accommodative until we have reached full employment. So all of this is basically speaking to our picture that the Fed is not going to move away from their current positioning, and also that they are seeing inflation expectations in line with what we see, that it's probably more current, again, speaking in the global space, probably a more current occurrence, and that we will basically have to look through that, and that long-term inflation expectations in the United States will actually settle at a quite average level. Okay, so all good news as we think, and we've put this also in some charts. So this is as of the 1st of April, basically a snapshot of the slope of the 10-year, 2-year yield curve. So basically just the spread between the 10-year point and the 2-year point of the curve in the United States. And you can see this sharp spike and this sharp move of back-end rates going higher. And we see that as positive. So let's look at a little bit of history there. If you go back into like 2007, 2008, so after the great financial crisis, when we saw this steep spiking of the yield curve, it was actually the start of like a 10-year bull market. If we go back into the late 2000s, after the burst of the dot-com bubble, we saw the spike of the yield curve. It was again the start of a quite long-lasting bull market, all the way up until 2007 or the great financial crisis. And even if we go one step further into the late 80s or early 90s, when we saw the steepening of the yield curve happening aggressively, it was basically the end of the emerging market crisis, and again the start of a strong bull market, especially for emerging market assets. Okay, so that's just a very preliminary view that a steepening of the yield curve normally is good for risky assets and good for risk markets and good for equities. And we're not going to proclaim that this is the start of a new bull market right now, because we are starting from far more stretched valuations. But if this would be our sole decision-making tool, and we would have nothing else in the tool set, obviously we have a lot more in the tool set, but if this would be our own single decision-making tool, we would be positive because of this indicator. There's nothing negative in the steepening yield curve. So let's look more to the front end of the curve, that part of the curve which I mentioned earlier, where you have to look out for whether the curve eventually starts to flatten again. So what we're looking at this chart is we're looking at 3 months LIBOR, and we're comparing it against 3 months LIBOR 2 years forward. So the reason why we're doing that is because we're basically comparing where are 3 months interest rates in the United States now, and what does the market expect them to be 2 years from now. Okay, so it's 3 months interest rates spot minus 3 months interest rates 2 years forward. And what you can see is that we've just crossed the zero line. So the market is now just telling us 2 years from now, 3 months interest rates will basically be exactly where they are today. So we've just moved away from more rate cuts into like a state where the market thinks interest rates are going to stay the same. Okay, not quite, because you can see on the y-axis it's actually like 25 bips positive the spread now. So we're starting to see the Fed pricing like half a hike, Fed being priced for like half a hike in 2 years time. So getting there, but as long as we are close to the zero line here, that's basically just telling us that we have absolutely no reason to be concerned about tighter financial conditions. Okay, that's the same story, just a slightly different picture, slightly different data source, because now we're looking at effective Fed fund futures. So we're looking directly at the whole curve of the pricing where the Federal Reserve is expected to be. So the green line is basically the current level of the Federal Reserve. So we are in that corridor between close to zero, between 0 and 25, where the Fed is targeting interest rates to be. This, I think, teal or turquoise line at the bottom is basically where we were 6 months ago. And then the dark blue line at the top is where we are now. So yes, we have seen some steepening, and yes, the back end of the curve has moved up even at the front end. So basically the 2-year forward 3 months rate has moved higher a little bit. But as you can see on the y-axis, again, same story. We are priced for, on the x-axis, once again, if you move all the way to like mid-end 2022, you're basically not even priced for one hike, and then at the end of 2022, you are basically starting to be priced for one hike. So our stance here remains that, yeah, the yield curve, if it keeps on steepening, it's good news as long as the front end doesn't move, and as long as it's driven by the back end moving higher and not by the front end necessarily being cut lower. It's all positive, and we should not be concerned about it. Inflation expectations, and that's probably what most definitely has driven the yield curve to steepen. So we're looking once again here at the 30-year inflation swap. So that helps us to see and to assess where the market thinks inflation is going to be on average in the United States over the next 30 years. So what you can see on this chart is that inflation expectations have jumped sharply. So basically from just 1.2, 1.3 to now 2.5. So that's more than 1% inflation more expected now over the next 30 years on average. So that's a massive move higher. And that's what clearly has driven the steepening of the yield curve. But are we at a level where we see it as necessary for the Federal Reserve to hike or to tighten financial conditions? No, not at all, because you can see that we're still at roughly 2.5. It's obviously also an inflation risk premium baked into these numbers, which means that pure inflation expectations are probably again lower. Call it 2% if we take out 0.5% of inflation risk premium. 2% is exactly the target of the Federal Reserve. In fact, they are willing to let inflation overshoot even because we were running lower for such a prolonged period. So long story short, absolutely no pressure for the Federal Reserve to do anything. Financial conditions are going to remain easy, and that's all good news. And we've just put, as you know, we always like to also add some evidence, some scientific studies behind our research or behind our statements and behind our work in general. So we've just measured very simply the slope of the yield curve, so the level of the yield curve, and then the correlation to a set of different asset classes. And what really stands out that with a small exception, I mean, no math is perfect, so no empirical study is 100% clean. So we, SA equities, we see a little bit of noise, but if we exclude SA equities, all the emerging market riskier assets are actually benefiting from a steeper yield curve. It's SA property, SA bonds, ILBs, preference shares, even SA income, like all the asset classes where we have overweights, especially bonds, ILBs, preference shares, they are strong beneficiaries from a steeper yield curve. And if we move to the right-hand side of the chart, you can see that the dollar-rand correlation is negative. So that means that the dollar is going to be weaker, the rand is going to be stronger. So the steepening yield curve, once again, also supports our case that the rand is even going to go stronger from the current levels. So a lot of positivity around South African assets from just the slope of the yield curve, which is one of the factors which we look at. As Rupert highlighted earlier, it's just one factor out of 16. So a lot of factors which play into a role, but it is encouraging to see that this major theme of a steeper yield curve actually clearly does support our stance on being so positive on South African assets and seeing a lot of value in South African assets. Okay, so this basically takes me to the last part of this presentation. So we're basically moving out of the macro themes more into like a brief summary of the balanced fund once again. So all the themes, obviously, they do feature through our models in a very systematic way. It's not that we analyze and identify a theme and position the funds in line with the theme. It's more that our models and our indicators are capable of picking up these themes and they are backed by evidence. And if there's a theme where we have a strong feeling that one of our indicator isn't, or that our indicator set is not capable of picking it up, well, we would clearly immediately question and interrogate the indicator set. But so far it has never happened. It has basically picked up all these themes in a very good way. Okay, so why do we do all of this so systematically? There's only advantages, in our opinion, with a systematic investment approach. There is literally no downside. We do think if you structure it properly, if you structure it correctly and dynamically, we can do everything which a discretionary or traditional approach could do, but we can just do it more efficiently and more accurately. We are eliminating human biases. I think that's probably the first and maybe even most important factor. Like human biases are the poorest advisors when it comes to long-term investment success. I mean, especially during COVID, we've seen it once again. Fear on the way down and greed on the way up. It's Not good if you give in to temptations here and do think that you can predict infection growth rates and stuff like that. We've always refused to do that. We rather always and never deviated. We've always gone with our systematic process. We've never deviated, and we have never given in to our gut feelings and our human biases. And we've got stable and predictable outcomes relative to our peers. So that speaks also to our portable alpha process. Don't stock pick, because the numbers just suggest it doesn't work. So it doesn't mean to any extent that there are no good stock pickers. There are surely a lot of good stock pickers. It's just very, very difficult to identify them before, and there's very, very limited correlation between how they've done in the past and how they will do in the future. Having said that, our portable alpha approach, it's more humble. It's not about good stories about shares. It's more about adding a little bit of alpha every single year. We've done that for 7 years in a row now. Outperformance of peers, slowly but steadily, measure tilts. So that's important to us as well. So we are never going to be the asset manager who picks the peak just before the crash of, for example, COVID. We're never going to predict the new virus to arrive and force us to have another de-risking taking place. We're also never going to be the asset manager who piles into risk at the bottom of the market. That's also not what we do. So we have generated positive alpha during the COVID crash, and we have generated positive alpha during the COVID recovery, but we've done that in a very measured and very consistent way, and that's what we are doing. And last but not least, scalability, which we get back. So Rupert mentioned earlier, we are covering a couple of million data points every day. But we're doing that with a team in the multi-asset space, with a team of 7. And everybody in the team is geared towards having a data science background, but also an economic background. And everybody in the team is geared towards bringing this together. So I do think that we can process more information, more data, and that we can make smarter and faster and more timely decisions than most of our peers, but we can do so at lower fees even, because we are not dependent on a set of analysts speaking to CEOs. So we are more nimble, we are more efficient, and we can process more data, and we can do that at a reduced cost. And because we can run our process at a reduced cost, and we are also convinced that low fees are a direct driver of investment returns, it's only natural for us to give back in the way of lower fees to basically create outperformance this way as well. Okay, so rolling alpha, this is basically just a chart highlighting how consistently we have beaten our peer group. So on the y-axis, you can see the percentile rank. On the x-axis, you can just see the time. So basically on the y-axis, if you are in the middle of the pack, you are average. If you are at the top, you are the best performing fund in the SUSE multi-asset high equity category. If you're at the bottom, you lost. The blue line is obviously the Prescient balanced fund, and the gray lines are all our peers. You can see that all the gray lines are very, very jumpy. So they're moving fast, and that's not necessarily a bad thing. It depends on your investment approach. So for some of our stock pickers, they are high conviction investors, and that's fine, and there's nothing wrong with it. And if you want to be following an investment style which every now shoots out the lights and then it's at the bottom of the pack again, that might come through time, as long as shooting out the lights happens more often than ending at the bottom of the pack. So that is not necessarily a bad thing. It can work. It's just not our approach. Like, our approach is different. Our approach is more about stability, about consistency. And as you can see in this blue line, we have never ever over a 1 year rolling period, it just had never happened that we even dropped into the last quartile. We have happened to be in the first quartile quite often, but that's not the point. The point is to consistently be better than average, so be above the average line in this chart in a very consistent and a steady way, and basically as often as possible. That's what you can see in this chart. So if you focus on the first bar, that's just 1 year, the 1 year rolling returns, and we just measured, like in dark blue, how often have we been in the first quartile, then in red, how often have we been in the second quartile, and in yellow, how often have we been in the third quartile, and then in teal, how often have we been in the fourth quartile. And you can see on a 1 year basis, we've never been on the fourth quartile, obviously also not in the 3 or 5 year number, so it just simply hasn't happened. And it shouldn't happen because of the stability of our alpha generation and because of our awareness of basically peer risk. So it shouldn't happen, and it hasn't happened, and I don't foresee it that we will ever be in the last quartile of a 12-month rolling period. I'll never say never, but it's unlikely given the way the process is designed. If you just combine on the left-hand side the dark blue and the red, you can see it's actually 90% of the observations that we are first or second quarter. So if you consistently first or second quarter over a 1-year period, over a 3-year period, you drift right to the top. And we've got like a 95% hit rate to being in the first quarter over 3 years rolling, and then 100% hit rate over 5 years or longer, obviously, where we've never drifted out of the first quarter. We can show this 5-year rolling through time in this chart. Why are we showing it? Because we also think if you focus on the gray line, that the gray lines that during COVID, for example, the gray lines became jumpy. A lot of our peers which de-risked aggressively pre-COVID have jumped right from the bottom right to the top. A lot of our peers which have been at the top and were amongst the more aggressive investors before have dropped right from the top right to the bottom. When it comes to our performance, it was steady. So we've been up there pre-COVID, we've been up there during COVID, and we will be up there post-COVID. So again, it's just about stability and being there in a very consistent and steady way. Not just the outcome matters, but also your journey. Okay, this is just cumulative returns since inception. So you can see that we keep on drifting higher and higher. So that doesn't come as a surprise to us. There is still a handful of funds ahead of us since inception, which is 7 years ago now. But yeah, given that they are swinging the bet in a bigger way than us, we are quite sure that we will catch up with those as well. And yeah, we are on track to doing so. Yeah, we've seen this slide before. This is basically just a summary of what we said earlier. Beat your peer cognizant composite benchmark in a very consistent and humble way all the time. If you get that right, you're beating your peers by a wide margin. So that's the story here. That's what we're trying to achieve, and that's what we have achieved over the last 7 years. And we spoke about this slide before as well. It's really just summing up our story. It is a combination of active and passive, but it's not a combination in the way that we're meeting in between. It is a combination which is really the solution, or in our opinion, the answer, or I'm very bold to say that, but the future of investing is picking the good elements of passive funds and combining them with the good elements of active funds and combining them in one solution. And that's what we're doing in the Prescient Balance Fund. Okay, so this takes us to the end of the presentation. Yeah, we finished after 58 minutes, so just in time. Obviously, we are very happy to take any questions if there are some. And thank you. Yeah.
Thank you very much, guys. I've got a few questions coming through now. So maybe if you can just discuss quickly, how does the Prescient Balance Fund capture asset classes such as, resources and things like that might fall out of your general scope, but how do those filter through to the fund?
Yeah, so resources are important, obviously, for the South African market, simply because they are such a large part of our economy. So we are captured. One of the indicators is basically looking at the price of industrial metals, or the momentum in the price of industrial metals. And that informs, for example, our view on the rand, our view on government bonds, our view on other risky assets. And that's how we basically play this theme of higher commodity prices in an efficient way. Are we taking on strong sector tilts, like allocating towards commodities, maybe out of industrials, out of financials, which has been a brilliant call over the last couple of months? No, we don't do that. The reason why we don't do that is because it introduces a lot of peer risk. So if you get this call right, you will be right at the top. If you get the call wrong, you will be right at the bottom. So it's difficult to be aware of the price changes in resources. I do think they have to be, especially for a South African investor, they have to be part of your process, but we don't necessarily feel that we have to take strong sector tilts because the peer risk is just so big.
Perfect. And then maybe just something looking a bit deeper into preference shares. Made mention of how we use banks, generally speaking. How does the view on preference shares change with tier 1 capital ratings changing and stuff like that? Does it filter in through to maybe a return, expectation for it, or is there a certain amount of risk added to the asset?
Yeah, so that is a good example of a structural change. So if there's a structural change to this asset class or to any asset class, we would immediately adjust our long-term return expectations in our strategic asset allocation process. We would rerun the optimizer and we would rebalance our strategic asset allocation accordingly. So that's how we always make sure that structural breaks or changes to asset classes, sometimes it's a single asset class like in your example, but sometimes it's also like a theme where we see like lower interest rates for longer. I mentioned earlier, more inequality leading to less economic growth. But whatever is structural, we would immediately reflect it in our strategic asset allocation and then rerun the optimizer, and it tells us what we must do with the asset class. Just into the example of preference shares and drilling into that deeper. So in terms of adding or introducing additional tier 1 capital, what that means is that on the capital structure, and that's also what Rupert meant earlier, on the capital structure, preference shares are actually ahead or come before AT1s. So from a pure credit point of view, they are the safer investment in our opinion. We do think that because of the change in regulation that they will be eventually retired. So we actually expect that the big 4 banks would buy them back and then the asset class eventually disappears. But if that happens, if they start to buy back the shares, they would only buy them back at par and we would only benefit. So yes, there's a risk that this asset class might completely disappear because of the change in regulation. But if I may put it like this way, it can only disappear in a good way. It can only disappear by the big 4 banks buying them back at a higher price. If they don't do so, we're happy to keep them for as long as possible because we're getting our yield, we're getting our dividends, and there's absolutely no risk in our opinion that those dividends will not get paid.
Great. And then just conscious of time, there are still a few questions that if we haven't got to them, one of the consultants will reach out to you to answer them. But maybe just in wrapping up here, how dynamic is your investment process? Do new asset classes coming into the industry, how easy can you adapt that to factor in new sort of investment vehicles, asset classes going forward?
Sorry, we're just muted here. Very dynamic. I think the strength of our process is not that we are using mathematically complex formulas to derive black box models. So that's not the approach. The approach and the strength of our process is really that we can process a lot of data very quickly and that we can adapt to changing market conditions. So that's straight into your question. What if a new asset class emerges? Well, we form with a lot of research, obviously, with a lot of empirical and academic backing to our thesis. We form long-term asset class views. We form long-term return expectations on the asset classes. We add them into the system. We rerun our optimization, and it tells us what we should have strategically in terms of exposure to that asset class. All of this can literally happen within a day. So we don't even need to wait to the end of the month for a rebalance like that. It's very, very nimble. It goes very, very quickly. If we would really include that asset class, if there's an emergence of a really new asset class, which we have a positive long-term expectation and it features in our strategic asset allocation, we include it. And then at that point in time, we would also apply our factor set, our 4 factors: valuations, economics, financial conditions, and sentiment, to basically form tactical views on that asset class. So yeah, to wrap it up, very, very quickly, new asset classes being introduced, absolutely no problem, it happens very quickly.
Great, thank you very much. And thank you, everyone, for your time today. Sorry that we ran slightly over. If you have any further questions, please reach out to your respective consultant and have a great day. Thank you very much.
Thank you.
Thank you. Yes.